In this video, we are going to answer the question, what is trading? This is the start of a new video series aimed at teaching you how to trade the financial markets using price action. I will start with the basics and progress step by step. If you find this video useful, please hit the like button, subscribe to Decisive Trading and be kept up to date on our new video releases. Okay, let's get started. What is trading and how does it work? Trading is relatively easy to understand. Fundamentally, we are simply buying and selling things. If we look at 4 random items, a bicycle, a scooter, a truck, and a car, then we can say that they all have a value. That is, what they would cost if you wanted to buy them. We can say the bike is £100, the scooter £1,000, the truck £20,000, and the car £75,000. Let's look at the bike in more detail from a trader's perspective. There is always a buyer and a seller of the good, and both parties think that they are getting a good deal. Otherwise, they wouldn't pay the price or accept the offer respectively. As a trader, we try and profit off of any buying and selling we do. The simplest way to think of this is in terms of buying, or going long as you would say in trading. You simply buy at price X and hold onto your position. You do this because you think the market in whatever you have bought is going to rise. If that happens, you can then sell at price Y and make a nice profit. Think back to our bike example. We buy the bike for £100. We do this because we think that the price of a bike is going to rise. After we buy the bike, there are suddenly a lot of interested buyers. There are more buyers than there are available bikes. So the price rises to £110. You make a nice £10 profit as you sell the bike. There are lots of ways you can trade as a retail trader. One of the most common is through a CFD account or contract for difference account. Let's look at our bike example in a way that would be more realistic to a trader. We will use the FTSE 100 index for our example, but it is the same for any market, forex, crypto, commodities, stocks and shares, or whatever. Now, you think that the FTSE is going to rise in price. You buy into the market at the level 7,000. The FTSE then rises to 7,010 and you sell for a 10-point profit. Now, let's say you are risking £10 per point, which would be spread betting. Or you had bought 5 mini contracts at £2 per contract, and that would be CFDs, which is contract for difference. These are 2 widely available instruments you can use to trade as a retail trader. This would mean you made £100 profit in both instances. A 10-point increase, 7,000 to 7,010, multiplied by your £10 per point is equal to £100 profit. Or the 10 points increase multiplied by 5 mini contracts, which cost you £2 per contract, is equal to £100 also, because it's 10 multiplied by 10. But what happens if the market falls when you are hoping for it to rise? Now you buy the bike for £100 and you expect it to increase in price. However, there are suddenly way more sellers of bikes than buyers. The cost of a bike subsequently falls to £90. You now lose £10 on the trade. Let's look at our previous example, where you bought the FTSE at 7,000. Instead of rising, it falls to 6,990, which is a 10-point drop, and you decide to exit the trade. In this example, you lose 10 points. We are still long £10 per point with spread betting, or we had bought 5 mini contracts at £2 per contract, and that would be CFDs. In both instances, you now lose £100. As traders, we can also profit from selling, or going short as it is called in trading. When we short the market, we enter into an agreement with another party. We say that we will sell to them at the current price, sometime in the future. They agree. In their minds, they are protecting themselves. They believe that the market is going to increase in price and want to buy at the current price. However, you believe the market is going to fall. If the market does fall, you can buy at a lower price, say £5. You already agreed to sell to the previous party for £10. So you fulfill the agreement and make a nice £5 profit. I want to buy a bike. How about we say £100? That sounds like a fair deal. Now I know I can buy the bike for £100, which is a fair price I can afford. And since I think the price of bikes is going to increase, I've done some good business here. I'm pretty sure I'm going to be able to pick up a bike for less than £100. Now, if the price of bikes does drop to say £90, you can still sell it for the agreed price of £100 and make a £10 profit. However, if the price of bikes increases to say £110, you have agreed to sell it for £100. That means you will make a £10 loss on the trade. Let's look at our FTSE 100 example again. But now, instead of buying, going long, you sell, go short, the market at 7,000. The FTSE then falls to 6,990, a 10-point drop. In this example, you gain 10 points. We were short £10 per point, spread betting, or we had shorted 5 mini contracts at £2 per contract, which would be CFDs. In both instances, you make £100. When you short or sell the market, you lose money when the market increases in price. So if the market had instead risen by 10 points to 7,010, you would have lost £100. As you can see, there is always a winner and a loser when trading. Your aim as a trader is to more often be on the winning side of the trade and thus profit. There are many other reasons why people buy and sell, with banks, companies, pension funds, hedge funds, etc., all involved in the financial markets. However, for the purpose of retail trading, those are the main components we need to understand. Hopefully, you can now answer the question, what is trading? If you enjoyed this video, please hit the like button. Subscribe if you are interested in learning more about the financial markets, and you can also visit our website at www.decisivetrading.info.